three. There it is. Okay. Now we can officially commence. It is 2/22. It's February 22, 2024, and I'm Tim Quast with Market Structure Edge. Brian Wilson is with me as well, and this is the live Edge demo and discussion. We try to do these every week, but and it's the aim is to help you use the data effectively. There are so many tools and choices that you have to try to help you make good decisions. We can say unabashedly this is a unique one. It's built on market structure, which are the rules and mechanics of the equity market. And we say don't trade price, trade supply-demand divergences. If you trade price, the machines that are in control of the prices will fool you. And you don't want that to happen. It's far better to trade supply and demand. So I'll talk about that. We're going to divide and conquer. I've got 3 points that I'll cover, and I think it's my turn. It's whoever draws the short straw has to go first. So I've got that, and then Brian's going to cap it off. He's got important things to cover, and we'll try to keep this focused. Last week we went just a little bit long, and I'll try to make sure that doesn't happen this time. Okay, so I'm going to share my screen, and Neil, I'll address your question first, and then get into these things that I want to highlight. So you asked, and I'll explain as background for anybody who's new or missed this last week. Neil, I think you asked, so when are these probabilities going to come at where you give entry points and exit points? So we're working on this. It's content that we're supplying to Interactive Brokers under we're a content partner, and it's been a long process to get here, and we expect this to be finished. Well, certainly before February. Everything takes longer than you expect, and this is nothing new for me. I have been building software for 20 years almost, and so I'm very well acquainted with how development processes go. And I don't do it; we've got engineers who do it. But I feel good about what we're doing with this. And so what we're aiming to do is to give you momentum and low volatility. And I'm going to explain this because I'm going to talk about this. I'll talk about what is the current, why today? Is there a reason why today NVIDIA would cause the entire planet to rally? Well, there are reasons. And there's the cadence of the calendar that you should know. There are mechanics. There's the mechanics of understanding how the market functions and how to trade things effectively. And I'm going to share with you a position I've got that I'm not happy about at all. And whether I would have done it differently or not is Sentinel-1S. And I'll tell you, in case you find yourself in a similar situation, where your probabilities are going to be high and where they're going to diminish, so that you make the choice. I mean, if you want to take more risk, you can, but you should also know when you don't have to, and you can keep the probabilities stacked in your favor. So this is what we're going to do. That momentum and low volatility, I'll explain the mechanics, but this is the low volatility portfolio, and it will be generally less than the market. The market averages about 2%. I think we capped this portfolio at maybe 2.2% volatility. So if I wanted to look at the most volatile thing in the low volatility portfolio, it would be COP, ConocoPhillips today. And if you were looking at ConocoPhillips, this is beta data. So this is a little different than what you will see, and there are things we're working on. But this is why ConocoPhillips is very appealing. It has steady demand and falling supply. That condition, more often than not, will cause a price to rise. Well, how would you know how much? Well, it gets to the core. And we're not trying to predict how much something is going to rise. We're trying to predict the probability that it will rise a predictable amount. So the whole market has a predictable amount of volatility. So if I were going to trade this today, this is not quite right. This is not for public viewing, but I'm sharing it with you. So the last close for ConocoPhillips is 112.87. So I would like to buy it in this range. I haven't looked to see where it is today, and I want to exit it in either today or up to 5 days from now with a 1% gain. And you say, well, that doesn't sound, why is that worthwhile? Well, add up 1% a day. If you could make 1% a day, you would kill every form of investment. You can't, it won't work. You don't trade every day. I don't trade every day. But if you could have a high probability opportunity to do that, this is just a 2/3 probability, by the way. So if we ran the data back 90 trading days and said, when this same condition exists in ConocoPhillips, in 1 to 5 days, including intraday highs and lows, could you produce a 1% return? Well, 67% of the time, yes. Now, is that good enough? We can debate that, but you might even be able to make 1.5. If you can make 1.5%, well, that's a very, and what you're after is removing the guesswork and the gambling from the equity market and turning it into a discipline and a process. And the only way that you can do that is by knowing two things. What is the money doing and how does the market work? In momentum, it's the stocks in momentum. Notice the NASDAQ today. So it's up 3%. Our volatility benchmark is 3%. That's the bare minimum for momentum. Why? I'll tell you. I'll tell you in just a moment. But here, if you looked at, Lyft is in this. So Lyft it has a 72% probability of producing a return of 2% or more in 1 to 5 days. And that's, again, looking at the trailing 90 trading days and tabulating what happens when it has the very same conditions that it does now. So where it's at 10 and the supply is trending down. It's above the trend line. That's not quite as good. And I haven't looked to see what Lyft is doing today, but probably it's doing well. Right? So that's what you want to do. And you say, well, why wouldn't I just do that with any stock? Why wouldn't I just go look at the intraday volatility? That is, if I take the previous closing price and I look at what is it? Pam, are you here? If you're here, remind me what it's like absolute, is it something range? Like there's a technical figure for
average true range.
Average true range. Thank you, John Cook. That's what I'm looking for. The average true range would be the same thing. Now we average it over 5 trading days. Why? Because that's where the patterns show up. The patterns of institutional movement of money tend to run 5 days. Do I know why? I can infer a reason, but I don't know absolutely. The market is driven by passive investment, which follows models, and it's very large, and it can't happen in a day. There's no liquidity in the market. The average trade size in the S&P 500 components is 90 shares. The quote is 100, but the average trade size is 10% less than that because you can't get a fill. Happens to me all the time. I could trade 300-400 shares of something, and I go look at what happened to my trade because it executes with an algorithm at Interactive Brokers. And son of a gun, it's 20 trades, for 1 share and 10 shares and 12 shares, all at different marketplaces. Why? Because the stocks have to trade between the best bid to buy and offer to sell. And those prices instantly change. An order comes in, and before even 10 shares can fill, the best price is somewhere else. Well, now the algorithm's got to go over there. And all that stuff happens in milliseconds or even microseconds. You can do a test. You can an algorithm can ping the market to identify the probability of a fill in macroseconds now. So this is the way that the stock market works. It's not a bunch of investors buying fundamentals. It is principally machines changing prices and speculating on how prices will move. It is the great bulk of what occurs. And a lot of that has to do with what we have chosen to do as investors. We buy ETFs. ETFs are substitutes that require arbitrage for a price. How would you price an ETF? It has no intrinsic value. It owns nothing. The stocks underpinning an ETF are owned by BlackRock, not you. If you own an ETF, you don't own an underlying pool of equities. You own something that trades in its place. And BlackRock owns the pool of equities, right? So then how would this thing have a price? Well, there's what's called the arbitrage mechanism, where if the ETF rises above the underlying basket that's been published, then people will short the ETF and buy the basket. And when those things change, then people will short the basket and buy the ETF. And this is what stabilizes prices, which brings me to the mechanics of edge. And I'm going to talk about 2 things. There are the basic mechanics of how the stock market works. So if you look at broad market sentiment here, And if you're new to this, what this is telling you is that there's three things. This is the price of SPY, the graph that corresponds to the price over here. Okay, that's the gray part of the graph. If they seem indistinguishable, there is one that only moves in a set range, and that's an algorithm called demand, market structure sentiment, broad sentiment, whatever you want to call it. But we look at that as demand. It is, and I'll explain what it is. And so there's one, two, three. There's supply on the bottom, the price of SPY, and demand. The supply and demand are taken from the 500 components of the S&P 500. And the algorithm is tabulating the way orders are handled in the equity market in the stocks comprising the S&P 500. And we normalize it to a 10-point scale. So, for a long time here, it was above the red line. Generally, that will indicate a market top. If the supply, are we getting some noise? Is it me? Is it someone else? Brian, can you find that? Maybe mute.
Yes, I'll check.
Thank you. Thank you. So just so we don't have background noise. So, and there's a point out of this. Okay, I have a point that is very important. But you can see supply and demand. If demand is peaked but supply is falling, prices will remain strong generally. If demand begins to rise and supply falls, then the market's really going to rise. It's a very predictable condition. And here's what I call 1, 2, 3. SPY, a proxy for the S&P 500, generally moves about 1%. It's whatever average true range, John, is that right? So the intraday volatility in SPY averages about 1%. The stocks comprising the basket that SPY tracks move on average about 2%. You can go look at it. At the volatility in the S&P 500, if you're using intraday high and low across 500 stocks and averaged, is about 2%. It can fluctuate, but call it 2%. Double SPY. Well, there's the motivation for the arbitrageurs. What am I going to do? I have a guaranteed return. And out of that, we can find high probability returns. Then now add in number 3, which is momentum. The momentum portfolio, we're looking for stuff that moves 3% or more. Well, it's a much smaller set of stocks, but you can kind of stack them together. There's stuff that will outperform the average. There's stuff that will underperform the average, and there's the average. And all of those things are in constant play. And whether supply and demand are increasing or decreasing will tell you whether you can go long or short. It's that simple. And you say, well, I'm not sure I'm following. Stay with me. So now what sets the price in the stock market? Principally, machines. It is 100% electronic. I know one trading desk that is putting in manual orders. Virtually everything in the market is algorithmic. Your trades are algorithmic. You're putting them in through Schwab or E-Trade or Ameritrade Schwab, now the same thing, or whatever, Trade Desk, or in my case, Interactive Brokers. They're using algorithms. There's no other way to comply with the speed and the regulations of the marketplace. So what happens? Well, a lot of stuff becomes automated, gets scheduled. It's built around the predictable volatility of the stock market. And out of that, we can determine how to be successful. I mean, you have to first understand those things. And you don't have to know everything. That's our job. Our job is to know those things. But to be successful then is to understand, okay, machines want something. They want that arbitrage trade, and they're going to get it. Citadel's going to make $20 billion, tenth a penny at a time, by making sure that ETFs and stocks track each other, and that your order gets filled. The SEC wants it. They're not doing anything wrong. They're doing what the regulators want, which is maintaining a continuous auction market. Okay, we're not going to outcompete Citadel. Citadel knows everything. It's why a price can be imputed around the planet. Citadel has servers, and I'm picking on Citadel. But it's not just Citadel, it's Goldman Sachs too. They have their servers parked in 220 global markets. They're in the Japanese equity market. Any exchange traded market, they're there, and all information is known simultaneously globally. And that's why the market develops this uniform characteristic. If all the prices reflect all known information, they're going to behave similarly. There are other reasons, but this is how NVIDIA's results can impute momentum to the entire planet. Now, is that a healthy condition? No. And Brian and I are going to talk about this at the end. We will talk about what's next, the good and the bad. There are things that are now very concerning to me. And it's because when you get outliers, I get concerned. When everything is hewing to the mean and the average, I'm not concerned. Then it's behaving in the manner that the market is designed to behave. 90% of orders are derivations of midpoint. Things should generally hew to the mean. When you have a consistent and prolonged period where you're not hewing to the mean, prepare. There will be a mean reversion, and it will not be pleasant. I'm not predicting it immediately. I am predicting that it will occur. Now, how do you know when? I don't. You got to watch how the data changes, and we can get to a little bit of that. So 1, 2, 3. If you want to trade, that's why this volatility works. Okay, I'm going to drop out of this and go back to here. Let's go back to real-time edge. Here's edge and the momentum portfolio. I'll have to log in as a result of that. Almost finished, and I'll hand it off to Brian here. So momentum today has 16 stocks in it. There are 3,525 stocks in the Wilshire 5000 index, total market index. So we are screening for things that meet liquidity criteria. We want to give you the best stuff, the stuff that you can get in and out of, that you can trade, that have the most predictable math. But really, there aren't that many things. Everything is owned. It's not like the market is full of things to discover. It's not. The money is concentrated in the largest stuff. So if you're going in here and bringing this to a conclusion, this is the whole point. If SPY moves 1%, let's just say ETFs have a tendency to have less volatility than the underlying basket because they're very elastic. They can be created and redeemed in mass, and it happens to the tune of $600-700 billion a month. That's occurring. So that's going to take volatility out of the ETF. Then the underlying basket is going to move more. If we want momentum, we want more volatility to trade. Then we want supply-demand imbalances so that we have an opportunity. So if I sort this now, here's Lyft again. And so if I want to look at Lyft, this is what gives you the advantage. It's knowing the supply-demand imbalance. More demand than supply tends to lift price. And you say, why did it not work right here? Because of options expirations. When options expire or earnings or companies report earnings, the probability that things behave in unexpected ways mushrooms. And why is that? Because so much of the market is depending on a derivative. If the value of the stock does not change, but I have bought a call, the call begins to lose value, right? It's not as valuable. If the stock falls, the value of the call goes effectively to zero, particularly if it's about to expire. So know that, if trading during expirations is very difficult and more dangerous. And if companies are reporting results, it's even more so. So my last little bit here is about Sentinel-1. So I own it. And am I happy about this? Well, of course not. I almost never do this. Only a fourth time. I almost never take any risk and because I don't want to. I'll take 1% risk and I'm out. And I just want to keep stacking returns. So the only reason I stayed in this is because it didn't move here. So on February 16th, options expiring, demand has fallen very nicely. It's a 10. Now I'm increasing my risk. If you're gonna stay and options are gonna renew on the 20th, what am I banking on? Wow, it's a risk. I'm banking on the fact that new options will bring additional returns. Sentinel-1 reported earnings back in December. It doesn't report again until March. So I can look at that and say, well, I'm not worried about that, but it's in the same part of the market as Palo Alto Networks. So do you need to know that? Well, just know that if anything happens that devalues the derivative, the calls or the swaps or the forwards associated with it, you are going to pay a price. Now, what do? Suppose this happens to you. Um, then what do? Well, you can take your lumps, or knowing that there remains a very strong excess demand and insufficient supply, you wait for the turn. And that will take 10 days probably. Now, I don't know that I don't like that. I'm just saying I'm not going to knee jerk respond to that because I know that what caused it was a reset of the value of derivatives. But I've got 30 days. People are going to return to those derivatives. But if you looked at this, what would you do? Well, all I knew at this point was I just cut my probabilities in half. I just magnified my risk. Is that a good decision? No. But you go in knowing. How do you avoid it? Don't do that. Don't trade during options expirations and don't trade during earnings season. There are 687 companies reporting results today. Still, we're not even out of the cycle yet. So you say, well, then when would you trade? Well, you don't have to trade every day. Time is risk. The more time that your money is exposed to the market, the greater your risk. It would be better to take 1%, 2%, 1%, 2%, skip the expirations period, come back, go back to taking 1%, 2%. Ooh, earnings season. Well, maybe I'm going to switch to going long and short the market. If the market has surging demand and falling supply, go long leveraged in the market. If it has the reverse, go short leveraged in the market. But that's how to think about it. Okay, that was a lot of information. Over to you, Brian.
Thank you, Tim. Good to be with everyone today. It's always a pleasure to work on these with Tim. Really appreciate the time. I wanted to start today by looking at, and I thought I had all my windows closed and I didn't. Apologies there. Wanted to actually just show you what was happening with Microsoft at the end of last week, and I think why that was affecting just broad market trading. And let me circle back one step here before I show you the edge data. We'll go to SSGA. So this, what you're looking at here, this is State Street, the sponsor for SPY. You can go to their homepage. You can go to holdings, and then you can download that. You can go to holdings, and then you can actually download the information. I did that today. I know my friend John, you do that almost every day. I just wanted to show you what's been happening, and I should have put a date on this. I think this was about 2 weeks ago, but you can see over time, the weightings will shift a little bit. Number one a couple of weeks ago was Microsoft. Number one still is Microsoft. Apple actually dipped down a little bit in their weightings. NVIDIA before today actually increased by about 40 basis points. That number will probably be drastically different tomorrow. Meta and Alphabet switched places, Eli Lilly, Tesla switched places. But here's the takeaway here. If we look at the top two holdings, that's 13% of the SPY just with Microsoft and Apple. And what I did is I just went down to 50 basis point positions. But if you do that exercise, that's 35 names. That's 51% of the SPY. Top 15 names, 37% of the SPY. So very much weighted towards the top end stocks. So I was watching Microsoft last week, and part of the reason why was because of that weighting. And I wanted to, I'll be honest with you, I wanted to buy intraday volatility. But every time I would look at Microsoft, the setup was just not good. Now, from a sentiment perspective, you can see sentiment was flat at 5. That's fine. I'd rather have it at 9 or 10, but 5 is good. But look at what was happening with short volumes. Short volumes were high, and every time I looked at that trade, I'm like, nah, I can't pull the trigger. Short volumes are going the wrong direction. Remember, Microsoft about 7% weighting. Look at what was happening with Microsoft and just the XLK, which is the tech component. Microsoft here is in dark blue. This is a 1-month chart. XLK is in light blue. So really, as Microsoft was moving lower, it was moving the whole tech sector along with it. And one way that I've started tracking this, and I showed you this last week, is I will just put my components, and I've got Walmart up here because I traded that yesterday. But you look at the top components, I will put those by weighting just at the top of my page. So I'm going to keep a close eye on those. And if I have opportunities there, I will go take a peek at them. So I traded Apple 2 times last week. Once again, I did not trade Microsoft because of that supply imbalance. But Apple, a couple of days, was below its normal intraday volatility. In fact, I think one day it had lost all of its intraday volatility. So I was trading it right through here when sentiment was neutral and short volumes were below trend. Once again, a very liquid stock. I liked the demand setup. I liked the supply setup. I went ahead and pulled the trigger, made money on that trade 2 days in a row. Walmart, I traded that yesterday, got out of the stock today, making the profit that I wanted to. Here's the reason why I traded Walmart. Once again, stable demand, and look at short volumes just moving lower. It was lower by all of its normal intraday volatility yesterday. Really good setup for trading, and I went ahead and pursued that trade. So that was just a couple of recent examples, with Microsoft. Once again, why I did not move that direction. The supply demand balance wasn't in my favor. You want to stack the odds in your favor. If this is going against you, that's not one I'm normally going to trade. If I am going to trade that, I'm going to trade it with open eyes, knowing that the setup is not as good as it could possibly be. I did mention in today's note the underlying activity going on with, sorry, I'm trying to get to, I can do it another way, I think. Sometimes the screensaver gets stuck up at the top. I'll show you a different way. I was mentioning underlying buying with today's note. And this is a report that we do on the IR side, on the investor relations side. But what I wanted to show you is this part right here. This is what we mean by underlying buying. So S&P 500 is what we're looking at, 500 constituents. The green means that the S&P 500 constituents were closing above midpoint pricing by the end of the day. Now, we had a couple of days there where the market was under pressure, but by day's end, you got that lift really across the market, especially yesterday, very strong into the day yesterday. And if you look at the edge portfolios, you can see, what's happening. And you can see that it was really passive money moving across the market. This was very clear in the big tech portfolio. And you can go to that portfolio and just look at the behaviors over here. So you see passive money was just absolutely dominating. Part of the discussion this morning is that passive money tries to get as close as possible to the reference price at the end of the day. Well, if there's underlying buying lifting the whole market at day's end, I would guess that would be passive money regardless of what was going on. Well, you don't even have to guess. You can see from our big tech portfolio that it absolutely was passive investors that were moving in that manner. So just a couple lessons there, why I was not buying Microsoft last week, why I did pull the trigger on Apple and Walmart recently. The example there with the S&P 500. And Tim, I'll go ahead and start the look ahead, and then you can tag in once I get done, or feel free to tag along.
Sounds good. Quick question from Joe for you. He said, were you
Yes.
hesitant on Walmart as they were reporting February 20?
I was not hesitant in that particular one, to be honest, because I missed that.
We all miss stuff.
Exactly, and that's a good lesson as well. You can, and I normally don't miss those, so thank you for the point there. You can check the NASDAQ site. You can type in earnings. NASDAQ does a really good job with their calendar, and you can see who's reporting. This is actually one of our clients reporting after the bell today, into it, but they'll have a listing there, and I could have easily typed in Walmart, and seen their information. But yep, good question, and I just absolutely missed that one. You just got lucky, which happens once in a while. I'll start with the all equity portfolio for the look ahead, and I'll show you how you can do this if you're interested. And it's literally just all the companies that we are currently tracking. So you just put in market cap, small cap, mid cap, large cap, mega cap. That will give you all of those components. So it's an even more inclusive look than the S&P 500. Of course, we're aware that as the S&P tends to move, so moves the market. But if you look at the all equity portfolio right now, 6.2, that's a pretty strong sentiment number. Generally speaking, anything above 5 is going to be good for equity pricing. And you can see that short volumes are now moving lower. That's a positive. If we look at big tech, and I was going to bring up big tech with today's note, probably regardless of what NVIDIA did. But if you look at big tech going into today, sentiment not quite as good. They had been under a little bit of pressure, 5.6, but you can see that recent drop in short volumes. Generally, when short volumes are moving lower for big tech, even if the market is under a little bit of pressure, that big tech short covering will tend to not make that pressure quite as bad, if that makes sense. So big tech looks pretty good. We'll see if that sentiment number starts to tick back up again, especially with today's activity. Broad market, Tim mentioned this briefly, but we're right now at 5.5, and short volumes retreated yesterday. In fact, on a day-over-day basis, in my all equity portfolio, that went down by 130 basis points. So there was some pretty significant short covering across the market. I would label this as good for now, but what we don't know is a couple of the components that Tim was sharing. I'll stop my share screen, but one of those components would be month-end activity next week. We're in the clear here for a few days from a macro perspective, but we do have month-end coming up. And if you consider what could possibly happen at month-end, I'm not saying that it will, but when you get to month-end, and if you've had this tremendous lift in the market, what could passive money potentially be at that point? Well, they could potentially be overweight equities. So I would see that as a consideration. I'm not making that claim right now, but as we get closer to month end, that's something that I'm going to be watching.
Yeah, so I'll just add quickly. We won't keep you much longer. I want to just point out a couple of things in context of what's next. And Brian and I were talking about this a little bit before the demo. So I wanted to point out just a couple of things here to think about. Let me see if this is the best way to do this. Well, here, let me do this. Let me go here. So this, if you go to marketstructureedge.com, I jumped there from the app, so it says product tour, and you go over to resources, and I've clicked the 2024 calendar. Here's why today is it just NVIDIA? Would it be different on some other day? Well, it might well. Today we're free and clear of the February options expirations period. The banks trued up their books on the stuff that expired last week and began trading on the 20th. And so this is the result of all of that. Now, what does that mean? Well, if the if the demand for derivatives is large and there are only a handful, just 5 banks are responsible for, call it 96% of derivatives, including equity derivatives, and we just came out of that cycle. Well, this can be the day where something can catalyze a global frenzy. And it kind of ties into my thinking about what's ahead. Look, you would generally say about us that we are neither bullish nor bearish. It's not how we think about things. We just look at the money. What is the supply demand balance everywhere? And we trade it. That's all we worry about. I will say, as I alluded to at the beginning, if we go for long periods where we are not hewing to the mean, it concerns me. So if you looked at, I'm just going to back up 3 months, and you look at the broad market sentiment, we crossed over the red line November 9th. And at the time, SPY was, call it 434. So, you can do it's 4,300 on the S&P 500. And we have spent a lot of time. We've not dipped below the green line at all. There's been no entry point. There's been no mean reversion in the market at all. And of course, the market during this period of time, if you think about its performance, it's in the 99th percentile, meaning it's in only 1% of the time has the market over history performed like this. I don't know if that's meaningful. It's not really how I think about it. I think about the market under Reg NMS. From 2007 forward is apples to apples. That's the regulatory construct that we have. But it's very unusual. We had this period where demand fell and supply rose, and the market should mean revert, and it didn't. That's unusual. It happened at January options expirations. It tells me that we were much more exposed to derivatives than we were or are normally. Again, does that concern me? I don't know. It's just that those are anomalies. They're 2 anomalies in a row. If you look at the supply side is no longer the kind of supply side that it was that gave us this rocket sled from November 1st into the end of the year. We're running at 50% supply. If you look at SPY, it looks fine. But that also says that's number 3. So number 3, SPY is effectively leading the market. It's the only derivative we have on the platform, and you can go look it up. And this is the proxy for the S&P 500. And if we back up and look at the same 3-month period of time, this is what it's doing. The supply side has come down and demand has been where it should be, about 5. Well, level demand, falling supply lifts the equity market. But generally, it's well below its normal level of supply. It's a very elastic instrument. So most of the time, it is more short than it is long, believe it or not. Because again, it's tracking a basket. And so to be less than that, and to have spent all this time at a supply deficiency, it all tells me that the market is heavily dependent on derivatives. So the same thing could happen to the whole market that happened to Palo Alto Networks. And I'm not saying that's going to happen. By the way, Palo Alto Networks is a customer of ours, and the investor relations, modernir.com side of the business. The reason you can lose 25% of your market cap is if all of the derivatives that depend on a future outcome get marked to 0, then 25% of the market cap comes off. It's not because investors sell it. I mean, why would you cut off your nose to spite your face? Oh, let's knee-jerk react and sell it for 25% less than it was yesterday. It's not how it works. That is not what's occurring. So if the entire market has that kind of exposure, does that worry me? Well, of course it does. And I think that there will be some violent mean reversion event. I don't know what's going to cause it. You could go back to May 6, 2010. There was no real cause except euro-dollar divergence. You could pick any. What about this date in 2020? It was new options trading. And the market fell apart February 24, 2020. February is important. Look, I'm not looking for that. We'll just look at the data. We'll look for any anomalies. But one thing could reset the market. And when we have this frenzy, when stuff when the entire market behaves like a momentum stock, those are things that indicate there's too much dependence on derivatives. So what do you do as a trader? Well, keep your time frame short. Take your little gains and be happy. Try not to have heavy exposure to a market that is dependent on derivatives. Just do it a little bit at a time. Okay, that's all I've got.